But yeah, mortgages and insurance, the least sexy part of the entire real estate transaction. So, Bill, let's talk about it.
Yeah, all the stuff behind buying the house that you don't want to think about.
100%. No one wants to. No one's calling you like, "Hey, can you tell me about this house I'm thinking about buying?" Like, does it ever start there? Have you had that happen before?
No. I get that on cars sometimes where people go, "Oh, I'm thinking about getting this car. What's that going to do to my rates?" No one ever asks, "I'm thinking about buying this house. What's that going to do to my insurance rates?"
Okay. That we talked about this a couple weeks ago. The difference between you being over there at State Farm and some of these online retailers, because I have the same issues on my side of mortgages. And we talk about how service and how coverages are much different. Like, getting the cheapest doesn't mean it's going to cover you if something actually happens. Is that kind of true?
Absolutely. So, each state is a little bit different, but here in Washington, you've got different levels of the homeowner's policy, the unendorsed and the endorsed and the special loss and all that stuff that no one really cares about. But what it boils down to is that there are companies out there that will package that, and they'll use terms like, silver, gold, and platinum, or like, value, premium, ultimate, right? But basically what that all is they're saying there's different tiers of coverage that they're covering your home for, different causes of loss, right? Yeah. So one of the biggest things to know is that there are some policies that list what's covered. So they will only cover your home if this list of things happens to them, right?
So it's very specific.
Fire, lightning, explosion, riot, terrorism, these sort of things, right?
Okay.
But it is a very specific list. And if it's not on the list, it's not covered, right?
Oh, okay.
And then the highest level of coverage is what's called a special cause of loss, which basically means everything's covered except what's specifically listed as an exclusion.
That's my type of insurance policy right there.
And that's the only kind we sell. And it's the only thing that people want to have, right? And that's where you get into the big tension with insurance is everyone who's buying an insurance policy is looking for, how do I save money? Because the commercials have taught you that the only difference between insurance is how much money they can save you by switching.
It's a race to the bottom, right? They're not selling on, hey, we actually take care of you if something happens.
Exactly. But when something happens, you want the best possible coverage you can get.
I would think so.
Right? And so what you really need to be doing is comparing what is the best coverage cost from the different companies, right? I'm not saying everyone should go with one company because they're better than the other, but I am saying that you have to compare apples to apples, which is what is premium coverage, the same amount of dwelling coverage, the same special causes of loss, the same amount of personal property, the same amount of loss of use. Like, what does that cost between companies? Because you may go, oh, this company's $300 cheaper, and then realize, oh, that's because they're insuring half of the stuff that I would get insured somewhere else, half of my personal
When you
property.
talk about half, and then you're talking about $300, it should be a no-brainer to spend the extra $300, right?
It is for me. It is with my house. I want the best coverage because I've seen houses that have caught fire, had a tree fall on them, or all sorts of crazy things happen, and you want it covered. You want the best coverage you can get.
Well, it's crazy when you talk about that because in every sales aspect, everyone wants to talk about what's your lowest interest rate, what's your lowest price you can get me. Like, it's all the same, and the clients that you like are the ones who are like, hey, what's my coverage? Mm-hmm. Hey, what's my 5-year, 10-year plan? Like, those are the real conversations. Those are the clients that you're trying to get everybody to mentally get to, because these big corporations spend so much money to talk about how cheap everything is, but nothing's actually cheap.
Right. and bridging it with like the loan piece of it, sometimes you've got to get the lowest price so that you can fit into that.
The loan to values and
you've got that loan to value. You're like, I can only afford this much for my homeowner's insurance, right?
100%.
And that's fine to get into your loan. But one of the first things people should do is once they get their loan, review that coverage and then look at, how much is it going to cost? Sorry about that.
Oh, you're good.
But go, how much is it going to cost me to then change that to the coverage I want? Because maybe you couldn't afford that $20 a month to get the loan. Once the loan's secure, you can afford that $20 a month, and you need that $20 a month to cover yourself properly.
Well, people don't think about that also. Like, we have to qualify based off today's facts, like today's taxes, your insurance you're paying for now. That's what we use to qualify them. But once we close that loan, it's kind of like a nice little hack almost. Is you can call and update your insurance and get it higher and get those coverages after the fact. 'Cause the taxes are going to go up. We're not complaining if your insurance goes up. We're just not requalifying you based off of that.
Exactly. And one of the biggest things is deductibles, right? That's one of the easiest things to change is you can go with a high deductible, 5,000, 1% of the loan, 2% of the loan, whatever, to keep that premium down. And then once the policy issues go, okay, now I want a $1,000 deductible, or I want, and I'll pay that extra $100 a year, and I can pay that out of pocket,
What is a coverage that most people don't ask about that they should have or have higher coverages on?
One of the things that people don't think about, and that's a great question, is liability, right?
What is liability? Not everybody knows what that is.
So most of what you're looking at when you're looking at homeowners insurance is the dwelling coverage amount. That's the amount to rebuild your house. Fire burns down your whole house. You need a dwelling amount that's going to rebuild your house.
So that's the roof, the walls, the frame, the foundation. Okay.
And then usually included is a percentage of that's your personal property. That's your clothes, your furniture, your TV, your appliances.
Is that standard or can that be adjusted?
It varies from company to company, right? So like at State Farm, we automatically always include 75% of whatever it costs to rebuild your home, 75% for your contents. Some companies it's 50%. Some companies it's 25%.
Huge difference.
It can be a massive difference.
Okay.
Yeah. But liability is usually standard at $100,000, right? And what liability is someone comes onto your property and they get injured or something happens to them and they sue you because of your negligence, right? Mailman comes up to the door, steps on a kid's toy you left out, slips and falls off of the stairs. He sues you, right? Your liability is what protects you from being sued.
Okay.
And a lot of times, like for us, going from $100,000 of liability to $500,000 of liability.
Huge difference.
It's usually about $50 a year.
That's nothing.
Right. So you're talking $4 a month to have an extra $400,000 to protect you in case you got sued.
That's
from
less
someone
than a
coming
cell phone bill.
It's half a coffee a month, right? But the other thing to think about is with liability, one of the unspoken coverages is duty to defend, right? And so basically what that means is your mailman sues you. Your insurance company is your lawyer. So they're the ones that are trying to defend you and prove that it wasn't your fault and that you don't owe them that money and that you weren't negligent, right?
Everyone's heard those stories of a robber coming onto your house and hurting themselves and suing you, or someone coming on your property and drowning in your pool. Like
exactly. And what most people don't think about when they're shopping for insurance, if you're going online and trying to save money in 15 minutes or less, that's not how you would probably select a lawyer to defend you in a lawsuit.
I would hope not.
Who's the cheapest guy I can get in less than 15 minutes?
So you're telling me that Walmart suit versus the Louis Vuitton suit, there might be a difference between the lawyers?
Exactly. And so when you're looking at quality of insurance company, when you go with the cheapest insurance company, you're choosing the cheapest insurance company to defend you if you were ever sued in that situation.
That's a good way to put that. I like that.
So there's a lot more to it than just the bottom line price.
Okay. So long term, people should actually think about their insurance and not just pull out their credit card and buy.
Mm-hmm.
Now, when you coach people on that, do you expand it outside of the home buying? Like, what about like cars or motorcycles or umbrella policies? I hear a lot about stuff like that. Are those things you can handle also? And
absolutely, we do all of that, and the bundling is where all the savings are. Our research shows that people who have auto insurance with a company switch on average every 12 to 18 months.
Okay, that's a lot.
But if they have auto and home, they stay for about 7 years.
Okay.
If they have auto, home, and one other product, like life insurance or an umbrella policy, they stay on average 11 years with the same company.
So it's a retention tool for you, but a savings tool for them.
Exactly.
So it's a win-win.
So you go, well, why would, like State Farm, my company, for example, we will give you 30% off of your homeowner's policy if you have a car with us as well.
Just one car.
One car. One or more car, we're going to give you 30% off.
That's
now,
a lot.
Average home policy here, it's usually around $1,000 a year. So you're talking $300 a year savings by adding a car.
That's a lot.
It is. And so that's $25 a month. So I usually tell people, even if I'm exactly the same price as your current auto insurance, but you need home insurance with me. By switching your auto, you're saving $300 a year on your home.
It's a no-brainer.
It's a no-brainer. And we're giving you that discount not because somehow now your home is at less risk of burning down or that we were overcharging people by 30%. We have that leeway, but we're going, retention is worth 30% of that cost to us because it's more valuable to have a client over the long term because losses even out.
It's nice to hear someone just like explain the whole business, right? Because everyone talks about insurance as I'm required to pay them, they're not required to pay me, and that just seems to be like an idea that people have behind them.
It is. It's funny because there's a term for that. The legal insurance term is aleatory.
Okay.
Right? So an insurance contract is what's called an aleatory contract, meaning it's not equal. Right? What drives me nuts is when people go, I put all this money in for years and years and years and I never took anything out, so why are they raising my rates, right? But that's not how the contract works. What it is, and do we have a few minutes to get into this?
Baby. She'll cut us off.
Here's what I love is the history of insurance. Insurance started in the 1600s in London in a bar.
Oh, no shit. Okay.
Called Lloyd's of London.
Okay.
And what happened was you had these guys in ships, and they would spend all their money buying cargo for their ships and then sail and then sell the cargo to try and make a profit, right? If that ship went down in a storm, if they got attacked by pirates, they lost everything, and they were completely broke. And so these ship captains got together and they said, rather than put my entire livelihood on my ship and if it goes down, I'm screwed, why don't we all agree to share in someone's loss? Okay. So if one ship goes down but the other 5 make it, we all share in the profits so that no one's ever completely destroyed.
So in theory, it sounds phenomenal.
It is. And that's the concept of insurance, right? Is that when you pay your homeowner's insurance premium each month, you're not putting that money into your bank to pay out in case your home ever burns down. What it is, 999 people pay their premium and nothing happens. And the 1,000th person, their house burnt down. And instead of them being completely destroyed, the premiums from those other people went to help rebuild that house, right? So we're all sharing in each other's loss so that we all experience a little bit of loss every month. That's our insurance premium. So that if we ever have a catastrophe, none of us ever experiences catastrophic
Ideally,
loss.
no one wants that to happen, but it happens, right? I mean, how many claims do you guys process in a day, week, or a year?
I mean, it depends on if you're looking at like a micro level. My agency office, we probably have 1 or 2 homeowners claims a month. We have 5, 6, 7, if it snows, 29 car claims in a month, right? Yeah. But it all kind of varies. As a company, we process billions of dollars of claims every year,
Which is a ton.
And it is. And that's another important thing to think about in comparing companies too, right? Because if you go with a local company, and there's some good local companies like Pemco or Mutual of Enumclaw, right? But these are local companies. So if all of their policyholders are in Washington, and Washington experiences severe windstorm or severe wildfires,
everybody's getting
all of the rates for that company have to go up to compensate, right?
That makes sense.
Whereas a national company, if one region experiences a tornado or one region experiences wildfires, there's that risk is spread out over so many more people that the rates tend to stay steadier and not have dramatic rises.
That's awesome. Speaking of that, though, I think we talked about this a couple months ago about how credit is changed, and people with good credit, their terms and their prices are actually going up. Is that true? Did that pass? What's going on?
So the Washington State Insurance Commissioner issued an emergency rule that credit could no longer be used in rating. Okay. For any insurance company, new business or renewals. That kicked into effect in August of 2021.
Okay.
That was, from what I hear, overruled by a judge.
Okay.
Might be in an appeals process now, and then there might be a rule that's actually going through the legislature right now to try and make it a permanent thing.
It's going through the correct channels this time, not just forced down everybody's throats.
Right. But the ultimate thrust of the rule was credit shouldn't be used because it's not an accurate depiction. If you look at the Washington Commissioner's website, the Insurance Commissioner's website, he'll say, well, credit has nothing to do with how you drive and whether or not you're in an accident. I agree with that. That's true. But the problem is that insurance companies don't only lose money on accidents, right? They give grace periods to customers that are behind on their bills. And what happens is a lot of times a customer will not pay their bill. They'll have insurance for 30 days, then they'll get a bill for 2 months. They don't pay it. Finally, the policy cancels, and then they just switch to the next insurance company and sign up and pay for that month. So essentially, they took a month and a half of quote unquote free insurance from the previous company, right? And that type of behavior costs the insurance company literally millions of dollars. Right.
So like landlords, they're able to see rental history, and they care less about the credit per se. If you have a million medical collections or whatever, but if you have, say, a $5,000 bill to another landlord, they take that pretty seriously. I mean, I feel like parts of credit should be able to do that. If someone was jumping between insurance companies,
right,
you guys should be able to see that.
Right. And so insurance companies have never like run hard credit reports. They're not running credit reports to see who you owe to who. They're just looking at that FICO score, right, to get an idea of, is this person likely to continue to pay their insurance premiums on time, which may not be a predictor of accidents, but it is a predictor of loss to the company, which impacts rates for everyone.
So it's really just an algorithm,
and so
right?
It absolutely is. And different companies put different weight on it. And so I think the insurance commissioner is a little short-sighted when he's like, well, this doesn't affect how you drive. Well, not everything about the insurance company in regards to auto insurance is how you drive. You know, and the same with homeowners insurance. And so it's a tricky situation. I think let a company offer whatever rates they want. People will, the market balances things out. If a company's weighting credit too heavily, then the people with good credit can take advantage of that. And the people who don't have good credit can go to a company that isn't weighting it as heavily. Why do we have to regulate it?
Like, haven't they already done that though? Like, all the companies have kind of found their niche for the most part of what they're doing. Like, you guys compete. Like, you guys offer more services. I mean, little bit more money, but you're going to be covered. And then you have other online retailers, I guess, that will be the cheapest, and they chose that niche, right? Like, Why does that need to be regulated?
If I'm elected to insurance commissioner,
well, I mean, you were the mayor, right? What city was that?
I was for Gold Bar.
Okay, so you're a little familiar with how things work. You saved them a ton of money, didn't you?
I did, yeah. That was a good time, good experience, good city.
Are you gonna do it again? Are you gonna run again for another city?
No. For now, focusing on my family and taking care of them and building up the business.
So you actually know how to take care of people, take care of city, take care of communities. You actually lived that and done that.
I do, and that you know. Obviously, there's good and bad people in every industry, right? But a good insurance agent is one that isn't just focused on sales and profits and numbers, but one that is really going, what my job is to educate people, to help them understand what they are actually buying, what it actually covers, what the promises actually are, and then to be there to protect them and help them in those moments, right? I mean, a lot of people think, you know, in the worst moment in your life, the first person you're going to call is, you know, your parents or your kids or your priest or something like that, right? It's usually your insurance agent. When your house is on fire, when someone's in a car accident, when someone's in the hospital, if someone passes away, one of your first calls is to your insurance agent. And so, like, as in selecting an insurance agent, you're also selecting who's that person that's going to be there, that I can actually count on to be in their office, that's going to pick up the phone, that's going to return my call, that's going to actually walk me through this and not click me over to another 1-800 number where I have to explain who I am and what's going on 7 times in a moment of pain and crisis, you know? So there's a lot to it. And not everyone's going to do that. Not everyone's going to care, but they should.
Well, I mean, I feel like people should seek out those people also. I mean, I get it the same way. Like, hey, I want to talk to you about what your goals are for retirement. I don't care if you're 22 years old today. Let's talk about what your next 40 years look like in real estate. Where other people, you can go online, shop, and you'll get transferred. Same thing. You have an issue, you don't know who to call. You call the 800 number, they transfer you 7 different departments and circles. I mean, that's why working with someone local is actually nice, right? Like you. Do you prefer local business, or do you go to the big chains for everything?
I go to as many local businesses as I can, you know. And it's funny because the older you get, the more not to be sexist with it, but guys, right? They can be guys or girls, but it's like, I've got a guy for that. You know what I mean?
100%.
You've got a mechanic. You've got a guy you go to when your car breaks down. You've got a guy to go to when you need to hook up with some concert tickets.
I don't have a company. I have a guy. I have that person.
You've got a guy you go to for beer recommendations, right?
100%.
Yeah. So it's like, you develop this like slew of guys and girls that are like, oh, this is who I go to for that because I trust them, right? And
because they give you service, they give you recommendations, and they give you trust, right?
Yeah. When I was younger and broke, I used to try and buy shoes online because they were cheaper.
I remember doing that.
You never get a pair that fits. I mean, you send back more than you get, and it's never what you want it to be, right? And eventually you go, you know what? I'm a grown up. I'm going to go somewhere and I'm going to try stuff on. I'm going to pick out something I'm
going to talk to somebody.
I'm going to talk to somebody. I'm going to, figure it out. And it's the same with everything, right? You grow up and you go, you know what? I need someone I can count on who understands this, who can actually help me find the right thing that fits.
100%.